Two brokers, same firm, same lender panel, same town, same number of cases. One earns 60 grand a year and the other one earns £140,000 a year. They're advising on the same mortgages with the same type of clients, with the same qualification on their wall. There's nothing separating them in skill. There's nothing separating them in product knowledge, nothing separating them in compliance. The only thing that's separating them is protection. See, that gap, 60 versus 140, that exists in every brokerage in this country. It's the dirty secret in the UK mortgage brokering industry that almost nobody will say out loud. And by the end of this video, you'll know exactly which side of the gap you're on, why, and what to do about it. I'm going to walk you through the three specific things the brokers on the 140 side do that the brokers on the 60 side don't. And that's the whole video. 3 mistakes, 3 fixes, and 1 income gap explained. Along the way as well, I'm going to cover what protection actually is, how to introduce it without feeling pushy, the single positioning technique that quietly does most of the work for you, how to handle the moment when the client actually pushes back, and how to write the case up afterwards. And there's one idea that we're going to keep coming back to because it's the engine of this whole entire skill. Protect the income, protect the goal. Get that line into your bones and your entire conversation is going to become significantly easier. Now, before we get into those mistakes, let me put numbers on the gap so that you can actually feel it properly. Take a standard residential mortgage case. The lender pays you a proculation fee or a proc fee, somewhere between 0.3 to 0.4% of the mortgage. Now, on a 250 grand mortgage, that's roughly going to be about 750 to £1,000 in your pocket. Now take the protection on that same case done properly: income protection, family income benefit, critical illness, life cover where appropriate. The commission can land anywhere from say £800 to well over £2,000 on the same client, off the back of the exact same conversation. So in a typical case, the protection income matches or even beats significantly mortgage income. Same client, same hour of work, sometimes more money than the mortgage itself. In fact, nearly always going to be more money than the mortgage itself. Now you multiply that across 100 cases a year and the maths become brutal. The broker doing protection properly isn't a tenth ahead. They're not 20% ahead. They're earning roughly double for the same case volume, the same skills on the phone, the same firm, the same panel. And that is the gap. That is why this matters so much. The protection isn't a bolt-on to the mortgage broker business. Protection is the entire engine for most brokers' income. So then why do brokers leave it on the table? Well, there's 3 reasons. Let's go through them one at a time. The first thing that 60K broker is going to do, they're going to bring it in at the wrong time. They focus the whole conversation on the mortgage. They take the application, they go to the offer, then they send it through to the solicitors. And then almost like an afterthought, they ring the client and say, oh yeah, just so you know, well, I got you. Shall we just talk about a bit of that life cover stuff? And by that point, they've already lost it. The client has got what they came for. The energy of the case is gone and the emotional momentum has been completely drained out of the conversation. So the client says, do you know what? Let me think about it. And they never come back to you. Now, the 140 grand broker, they do something completely different. They introduce protection at the very first conversation, not as a sale, but as part of what being a client actually means. At the discovery call, they say something like, here's how I work. We're going to look at the mortgage and what fits your situation. Alongside that, we're going to look at the bigger picture, because a mortgage without the right protection in place is a liability that can collapse the first time something goes wrong. So we're going to look at both of it together. That's the whole job. That is the mortgage package. That's one paragraph said on the first call, and from that moment on, protection isn't a sale that's been made up later. It's an expectation that was set right at the start. Then there is the research phase, the bit where you're going to find the right mortgage. You should research the protection alongside it. Same time, exactly the same time, not afterwards, not as a separate piece of work. Mortgage research and protection research should be parallel. And then you bring the client back in for what I call the submission call, a proper sit down before any mortgage application has been submitted. You present the mortgage recommendation, you present the protection, you close the protection, and then and only then do you submit the mortgage application. That order matters significantly. Protection closed first, mortgage submitted second, because the moment that mortgage application goes in, the client has got what they came for and your leverage is completely gone. Most brokers in the country are doing it in exactly the wrong order, and it's costing them their entire protection income. The second thing that 60K broker does wrong is they treat the protection as something separate from the advice. They get awkward. They drop their voice. They say things like, I just need, to mention something about insurance, or there's this little add-on that we should look at. And clients hear that and they immediately think, here comes the upsell. The 140 grand broker, though, they treat protection as part of the advice itself. They never use the words insurance. They never call it an add-on. They never apologize for the conversation because in their head, recommending protection isn't a sale at all. It's just the same regulated advice that they're giving on the mortgage. It's part of the full mortgage package. And the technique that makes this work is the single most powerful positioning tool I'll give you in this whole video is the income stress test. Here's the language word for word. Everything we're about to recommend is built on the idea that your income stays at least the same. Your deposit holds, your debts stay manageable, and your health holds up across the whole mortgage term. Before I submit an application on your behalf, where I'm telling a lender as a regulated advisor that I genuinely believe that you can sustain this mortgage for 25 years, I need to stress test the income that underpins it. That's not a sales pitch at all. That's me doing my job properly under consumer duty. Nobody's going to argue that, by the way. Nobody, because it's framed as logical, regulatory, and necessary. Not optional, not emotional, not a sale. The income is what services the mortgage, and if the income goes, the mortgage goes. So the income has to be stress tested before the mortgage gets submitted. It's not a pitch. It's an obvious next step. So use that script on every single client you speak to. Now a quick word on the products themselves. Let me give you the products through the lens of what they actually do, because the textbook definitions don't help anybody. Income protection is one that pays your clients a regular monthly wage when their body breaks. Their back goes, the mental health collapses, they're off work for 14 months, the mortgage still has to be paid. The kids still need to eat, of course they do. And that is what this product does. It keeps a life running when the engine has stopped. This is the most important product that most clients have never even heard of. It comes first, and then you have family income benefit, which is the one that pays a monthly income to the client's family if the client dies. It's not a lump sum, it's a wage every month for the rest of the term. Same purpose as income protection, but for death instead of illness. This and income protection are your essential covers. Lead with these, never with the cheap stuff, not with the basic life insurance. Critical illness cover pays a lump sum if the client is diagnosed with one of a defined list of serious illnesses. Now, the quality of this contract is the product. A cheap kick plan that excludes half of the conditions is worse than nothing at all because it gives false security. Always recommend strong contracts on this. Now, life cover pays a lump sum if the client dies. Cheapest of the lot of them. It is the one that most clients have heard of, and counterintuitively, the one that should usually come up last, not first, because a lump sum is what your clients think they need. A regular income, though, is actually what they need. Now, the order is the thing. Income first, always. Most brokers lead with life cover and decreasing kick tied to the mortgage because it's the easiest thing to talk about. They then run out of the quote budget, that I would say, before they've even got to income protection, which, by the way, is the bit the client actually needed in the first place. You should be reversing that. Lead with income protection and family income benefit. Build the rest on top of that. Now, mistake 3 is they talk themselves out of the recommendation. This is the one that genuinely hurts. The 60K broker presents a good recommendation and the client raises an eyebrow at the cost. And the broker, they then freak out and they panic. They say something like, we could actually look at some smaller amounts, or if it's a bit much, we could do a shorter term. And then they drop the recommendation before the client has even actually responded. And that's the broker talking themselves out of the sale. The client didn't say no, the client just paused. And the broker's discomfort with silence cost them half the case. That 140K broker, though, they do the opposite. They present the recommendation, then they shut up. If the client pushes back, they don't immediately drop down. They acknowledge the cost. They sit with it. They ask the client what they'd be prepared to give up to make it work. Only then do they reduce if needed. See, that one discipline, refusing to talk yourself out of your own recommendation, is probably worth 30 to 50% more average premium per case. That's not exaggeration, by the way. That's the gap between the brokers I coach who learn to embrace the silence and the ones who can't. Now, let me say something that nobody else is going to actually say to you. If you've been in this industry for 2 years and you're still avoiding the protection conversation, the problem isn't the conversation. The problem isn't the products. The problem isn't your clients. The problem is that you've decided your own discomfort matters way more than the client's family. That is the honest version. Every case that you have placed without protection is a family that you have left exposed because you didn't want to feel awkward for 15 minutes. And I'm not saying that, please, to make you feel bad. I'm saying it because it's the only way for you to stop it. The brokers who break through that gap, they don't get more comfortable with protection. They just decide that their job matters more than their discomfort. And that's the whole shift. Make it, and the rest of these skills will come way easier than you think. So let's talk a little bit about providers, compliance, and kind of writing the reports, because this is the technical bit we need to go through. So let's talk about panels versus holder market first. Most networks have provider panels covering the major insurers. For protection, that's usually fine because the major providers cover most of the needs. And the thing to check is whether your panel includes the strong critical illness contracts and the income protection specialists for clients with non-standard occupations. Don't obsess over the whole market. A good panel covers 95% of all of the cases that you're ever going to come across. And then we have compliance. Now, protection is regulated advice, same consumer duty expectations as the mortgage itself. Every case needs to be documented with a fact find, a written recommendation, suitability letter that the client signs, and a record of anything that's been declined and why. Most modern CRMs will generate the bulk of this automatically, but your job is making sure the reasoning is genuinely tailored to the client. So please do not do any copy and paste on this. It's what people teach in the industry. It's not a good idea. And let's talk about writing the protection reports. Keep it plain. Walk through what was recommended, why, what it would pay out in the event of a claim. The report isn't where great protection advice is judged. It's the document that proves the advice you gave was sound, specific to the client, clear in the reasoning. That's all it needs to do. So then, do all mortgage brokers have to do protection? Well, strictly speaking, no. There's no rule that says every mortgage broker must offer protection, but under consumer duty, you are expected to consider client outcomes broadly. And if you're not raising the conversation, you're arguably, in my opinion, not delivering the standard advice the regulator now expects. Now, practically, yes, you should. If you're not doing it, you are leaving your clients exposed and yourself underpaid, and both are unforced errors. You can't half do this. You're either a broker who does protection properly, or you're a broker who quietly leaves thousands of pounds on every single case. There is no middle ground, so pick one. Protect the income, protect the goal. So if you've watched this and you are starting to see how protection fits into the bigger career, your natural next question is, where does protection sit on the broker career path itself? What stage do you need to be in to have nailed it by? So the next video is right here on the channel. It's the mortgage broker career path from the trainee to the business owner, and it walks you through the 5 stages of a UK mortgage broker career, what unlocks each one, and why most brokers plateau at stage 3, in my opinion, without ever realizing that there are other stages above that. Watch that one next. Hit subscribe while you're there, and I'll see you in the next video.